Jerome Powell and the Federal Reserve just did a big pivot. They have now stopped hiking interest rates. With ABC News report that the Federal Reserve pauses interest rate hikes after 15 straight months of increases. And the reason that the Fed is pausing rate hikes is because inflation in America is now starting to come down. The BLS reporting that the year-over-year inflation rate has decelerated to 4% growth. You can see that that's down significantly from the peak of 9% in the last summer. However, it's still above this 2% inflation target that the Federal Reserve has. And since inflation is still above that 2% in target, it's still too high, Jerome Powell made sure to tell everyone that while they paused this month, they are not done hiking rates, with Powell signaling that there will likely be 2 more interest rate hikes by the end of 2023, which would bring the federal funds rate from its current level of 5.2% up to 5.7% by the end of the year. 5.7%. That would be the highest level for short-term interest rates in America since all the way back in 2001. And so what do these rate decisions mean for you as a home buyer or investor out there? Well, it means that in the short term, mortgage rates are likely to stay around their 7% range, and that you're not going to see too big of an increase in borrowing costs over the next month or two. However, it also means that likely interest rates are going to stay higher for longer. That was the big conclusion from this FOMC meeting, is that we're likely not going to see the Federal Reserve cut rates at any point in 2023. And this is now what's causing some people in the housing market to get a little concerned, because lots of investors in the housing market were banking on the Fed pivoting and cutting rates by the end of the year. Now that the Fed's not going to do that, I think we're going to see some distress enter the housing market, because there's lots of investors who are holding on for dear life, who are losing money on their rentals over the last 6 months. Because right now in America, we're in an interesting situation in the housing market where the cost of debt, or the 30-year fixed mortgage rate, is way higher than the cap rate or the profit for rentals that investors are getting. And there's lots of investors in the housing market. They own over 20 million homes, and many of them are losing money as a result of this increased cost of debt and low returns on their rentals. And so these investors do not like the fact that Jerome Powell is not going to cut rates in 2023. It seems like that's what he's saying, and that they might increase it even more. But of course, we're not necessarily seeing the evidence of people freak out right now in the markets. Like when you look at the inventory levels on the housing market right now, they're still low. We're not seeing people panic. New listings and new seller listings are at their lowest level of nearly all time. While that's happening, we're seeing the stock market boom right now, everyone. The stock market's in a bull rally, with the S&P 500 up 12% over the last 6 months. A lot of people are developing this idea that there is no recession and that we're not going to see the unemployment rate increase meaningfully. And you even saw that from the Federal Reserve's report today. When they asked the FOMC participants what they thought about the economy and the unemployment rate, they said that they thought the unemployment rate is going to stay low over the next year and that GDP growth is going to go up. However, folks, I believe that the people buying into the stock market and the people at the Federal Reserve are wrong about the economy staying strong. Because when I look at the fundamental data, which you should be looking at too, if you're a home buyer or real estate investor, I see all the fundamental data points still say that there's massive problems in the economy and that things are going to get worse. One of these data points is the US Treasury yield curve, everyone. Let me explain what this yield curve is showing and why it should concern you. Right now, the yield curve is showing that short-term US Treasuries are yielding over 5%, around 5.3% if you were to buy a 1-year US Treasury. Like, you could buy that right now and get a 5.3% return from the US government. However, what do you notice after 1 year? The return that you would get for buying a US Treasury starts going down sharply, and if you were to buy a 10-year US Treasury, you only get a 3.8% return. And ultimately, this is what's called an inverted yield curve, where the interest rate you get goes down the longer the duration of the investment is. And that is not normal, everyone. An inverted yield curve is historically a big sign of a recession. And you can see that every time the yield curve went negative between the 1-year and 10-year US Treasury, like it is right now, what happened? Well, in 2019, that was right before the pandemic when we had a recession. In 2007, it was right before the Great Financial Crisis. In 2000, it was right before the dot-com bubble. In 1989, it was right before the Gulf War recession. You had a lot of yield curve inversion in 1979 before the brutal double dip recession. You had big yield curve inversion in 1973 before the 1973 recession, where the unemployment rate went to 9%. And then you had big yield curve inversion in 1969 before the 1970 recession. Without fail, the last 60 years, this yield curve inversion has predicted a recession. So the fact that we haven't seen the unemployment rate spike yet, and the fact that the stock market's in a rally right now, I would encourage a lot of you guys to tune that stuff out, because the bond market is what counts in terms of telling you what's going on in the inner plumbings of the financial system. And the bond market is saying recession is coming. And I just want to explain to you guys why that is. Why does the bond market matter so much? And it's because it's telling you where capital is being allocated in the US economy. If big banks and institutions and foreign governments are piling into long-term US treasuries, which is pushing those yields down and creating the inverted yield curve, that means that all those institutions are not investing that money in other places. Like, they could be making loans or investment into the economy, but instead they're just giving it to the US government. And ultimately, this correlates often with what's called a credit crunch, when we see the appetite for lending into the economy go down, which is exactly what we're seeing right now, with analysts from Deutsche Bank saying that the credit crunch in the economy will spark a wave of corporate defaults and a recession as tight financial conditions put an end to the lending boom. In particular, these analysts said that there was a boom in credit over the last 2 decades resulting from ultra low interest rates. Now that era is coming to an end with tighter lending standards and higher interest rates. They predict that high yield bond defaults could rise to 9%, meanwhile US loan defaults could rise to 11%, close to the all-time high of 12% seen during the great financial crisis. And ultimately, what's scary is that we are already seeing this credit crunch play out. And the credit crunch is ultimately why the Fed skipped a rate hike, is because they're seeing what the banks are doing in the wake of all these bank failures that happened earlier this year. And, the banks are scared, so they're cutting back on their loans, and which is ultimately depriving the economy of money. A situation that we're seeing when you look at the loan data from commercial banks, with the growth in loans on commercial bank balance sheets decelerating to 8% year over year at the end of May. Now, that's still positive in terms of loan growth, but you can see it's now sharply decelerating. And every other time we see this sharp deceleration in loan growth, what happens? Well, we have a recession, everyone. That happened in 2008. That happened in 2000 during the dot-com bust. That happened in 1989 before the Gulf War. That happened in 1973, 1974 during that recession. And what's crazy is that loan growth doesn't even have to go negative for the recession to get bad. All it needs to do is just heavily decelerate, which is what it is doing right now. And so understand this: if banks are putting less money into the economy as the Fed is raising interest rates and also doing quantitative tightening, that's something that's going to make inflation very difficult to sustain, because ultimately more and more segments of the economy are going to run out of money. More and more segments of the economy are going to have liquidity needs, which is going to push prices of goods and services down and result in a lot of forced selling of inventory, something that I predict we're eventually going to see on the US housing market when all of a sudden households and investors start feeling this liquidity strain, which is building. You can see it coming, but it hasn't totally hit yet, which is, something to just understand. If you're someone who's been watching my channel for the last year or two, or who's just maybe kind of frustrated with hearing about recession and impending housing collapse, understand that these things take time to play out. The economy is a slow-moving beast, and the US government and Federal Reserve, they pumped trillions and trillions into the economy over 2 decades, right? And so we're now just over a year into our tightening cycle, and things have started to turn south, but it's going to take longer than that for the real progress to come in terms of prices going down. And one area I'm really looking at here to inform me of where the economy is going, and where you should be looking at too, is consumer spending. Because ultimately, consumer spending is 70% of US GDP. And the reason that the GDP growth has been decent so far this year is consumer spending has held up better than a lot of people expected. However, when you actually look at the data more granularly on consumer spending, you see that it's not so good. You look at retail sales data from the US Census Bureau. What do we see? Well, we had the big run-up in retail sales that occurred in 2021. Basically, consumer spending after stimulus checks increased big time. Then it increased through early 2022. And then what do you notice? Basically, since April 2022, consumer spending and retail sales have basically stayed flat. There's been no nominal growth in retail sales, which means that in inflation-adjusted terms, sales have actually gone down. And retail sales and consumer spending have gone down, especially for certain segments of our economy and our society, particularly Gen Z and millennial households. They're the ones that are cutting back spending the most, because they've been the ones hit most by, the increased rent, the increased mortgage rates. Gen Z and millennials move a lot more, so they're facing these higher costs, and as a result, their spending is now negative year over year. with a very interesting graph from Bank of America showing this. They break out the total credit and debit card spending per household by the age of the household. And what do you see? Well, the blue and the pink bars for millennial, as well as the gray bar for Gen X, they are all in negative territory on household spending year over year. So these younger generations are spending less, while baby boomer and traditionalist generations, which are older generations, they are still spending more. So this is super interesting right now. Consumer spending is not doing good overall, but the reason it hasn't crashed yet is because of the older generations propping it up. And one has to wonder how long that can last. How long can the US economy run off people over the age of 55 and 60 spending 3 to 5% more than they did a year ago, when the younger generations are getting hit hard and are going to get hit harder now that student loans are going to start to come back. Payments on student loans over the next couple months are expected to resume in September, with payments in October, which is going to be a big weight on spending for younger households. They were basically spending more than they used to because for 2+ years during the pandemic, they didn't have to make their student loan payments. Now they will. So that's going to be a further drag on consumer spending, just as the credit crunch is happening, right? Just as banks are now putting less money and fewer loans into the economy for businesses. The thing that's going to break in this economy is we're going to see, the consumer spending just incrementally go down by more in future months. But in addition to that, I think we're going to see a lot of the businesses, the failing businesses that exist in America, we're going to see them start to give up in the second half of 2023, now that they know there will be no imminent relief on interest rates. Now that they look at what Jerome Powell said, and now that they look at the dot plot from the FOMC, which is showing that all 18 FOMC members expect short-term interest rates to be above 5% at the end of 2023, and most of them think they're going to be above 5.5%. Now that businesses see that, they are going to say, okay, it's time to give up. Because sadly, everyone, unfortunately, right now, we have a lot of businesses in America that are losing money and who have been holding out because they were expecting a pivot. They were expecting a lifeline in a raft that does not seem to be coming. And, one segment of the economy I just look at for proof of this is realtors. I did a video a couple weeks ago about how realtors have started to quit, with the number of realtors in America in May being about 1% below where it was last May. However, folks, what do you notice is that the number of realtors is still way, way higher than the long-term average, even higher than it was at the peak of 2006. And a lot of these realtors, folks, they're not making very much money because home sales per realtor are at literally their lowest level of all time. And so we know a lot of realtors are not making money, but most haven't quit yet, which is just a great analogy for the economy overall. And ultimately, what I predict we're going to see is that in the second half of 2023, we're going to start to see the realtors really quit, which should be good news for a lot of the realtors, by the way, who watch my channel. If you're a good realtor out there, you probably want other realtors to quit so you'll get more business. But ultimately, that's going to be a signal. When the realtors really start quitting, that's going to be a signal that other parts of the economy are going to start quitting as well, especially a lot of the businesses that just are hoarding labor and don't make very much money. And now, one last thing we need to talk about, everyone, is the Federal Reserve. And it's not interest rates, actually, that the Federal Reserve is setting. It's the money supply that the Federal Reserve controls through their quantitative easing and tightening program. And right now, what a lot of people don't know is that the Federal Reserve is actively sucking liquidity and money out of the economy through quantitative tightening. They're destroying money by letting loans on their balance sheet basically just expire, which is basically money being destroyed. And the result is the money supply in America is continuing to contract. The supply of money in the economy now down almost 5% year over year and through April 2023. You can see that this is the first ever contraction in the last 50 to 60 years, and actually it's the first contraction going all the way back to the Great Depression. And so long as this money supply continues to contract, which basically means less deposits in bank accounts, it means less loans going out into the economy, that's another signal that inflation is going to continue to go down and that the odds of recession and even depression increase greatly, because every other time we've had money supply contraction in US history, we've had a depression. So watch out for that money supply as well, because it's a real double whammy hitting the US economy right now, and it's something that's going to have a negative impact on home prices. You can see the historical relationship between money supply and home prices going back 100 years is very, very clear. When the money supply goes up, the blue line, like it did during the pandemic, home prices go up. And then when the money supply goes down, home prices start going down, and this is lagged 1 year, so it's looking at the change in home prices lagged by 1 year to the change in money supply. And ultimately, so long as this money supply growth stays negative or stays low, we're going to see home price growth stay negative and stay low because there's going to be less money in the system to buy houses, which means that, some of the cash buyers who are in the market right now, Redfin reported that around 30% of the home purchases were cash sales in the spring of 2023. Well, that's great. The cash buyers can buy some homes for the time being, but the clock is ticking for them, because the deposits in their bank account, they're running down. The money that's going to be loaned out to the companies that employ these cash buyers, it's going down. And unless there's like a major pivot by the Federal Reserve by the end of 2023, like they start printing money again and slashing interest rates, we're going to see the liquidity in the economy and in the housing market run dry. And that's when you're going to start to see real economic turmoil that cause prices to go down